This one is easy to get wrong. What three levers create equity value in an LBO? And how do you reference them in a paper LBO? 5 seconds, answer out loud. EBITDA growth, from revenue growth and/or margin expansion, raising exit EV at a constant multiple. Debt paydown, deleveraging. FCF reduces net debt, so a larger slice of exit EV accrues to equity. Multiple expansion, exiting at a higher multiple than entry. Buy low, sell high. In a paper LBO, you can attribute the equity gain to these three buckets. Interviewers love when you say, most of the return here comes from deleveraging, not multiple expansion. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. Your competition already knows this one. A property generates $5 million of NOI and is worth $100 million at a 5% cap rate. If cap rates expand 100 BPs with NOI flat, what happens to value? And how much NOI growth would fully offset the move? 5 seconds, answer out loud. At a 6% cap rate, value falls to $5 million, or 0.06, $83.3 million, a decline of roughly 16.7% from a single 100 BPS move. To hold value at $100 million at a 6% cap, you would need NOI of 6% x $100 million, $6 million, i.e. 20% NOI growth, just to stand still. The takeaway's value sensitivity to cap rates is convex and largest when starting cap rates are low. 100 BPs off a 5% cap destroys far more value than 100 BPs off an 8% cap. Modest cap rate expansion can overwhelm years of rent growth, which is exactly what happens to low cap rate sectors when rates rise. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. Today's rep: how do fair value marks work in bank M&A? And why do interest rate marks come back through earnings? 5 seconds, answer out loud. At close, the target's loans, securities, and even deposits, short debt, are restated to fair value. Rate marks arise when acquired fixed-rate assets carry below-market coupons. They are written down, cutting day one tangible book. But the discount then accretes back into interest income over the asset's remaining life, mechanically boosting the pro forma NIM and EPS, which is why high-rate environments produce ugly TBV dilution, but flattering accretion. Credit marks absorb expected loan losses. Under CECL, non-purchase credit deteriorated loans additionally require a day two allowance built through the provision line. The much complained about CECL double count. Sophisticated investors discount accretion-driven earnings because they are a wasting non-cash tailwind. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. This question ends Super Days. Rank order for a classic mature industrial LBO, the typical relative contribution of the three drivers, and explain. 5 seconds, answer out loud. Classic order: debt paydown. High leverage plus strong, stable FCF makes deleveraging the biggest contributor. EBITDA growth. Modest organic growth plus margin operational improvement. Multiple expansion, usually assumed flat, so often near zero in the base case. Any realized expansion is upside. The exact split varies by deal, but for stable, cash-generative businesses, deleveraging tends to lead, growth supports, and multiple change is conservatively excluded. Common wrong answer: multiple expansion contributes the most. Buying low and selling high is the whole game. Why it fails: base cases assume a flat exit multiple, so expansion contributes roughly zero by construction. In a stable, cash-generative industrial, deleveraging typically leads, EBIT improvement supports, and any multiple change is ununderwritten upside. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. This one is easy to get wrong. What is the practical difference post-deal between value allocated to identifiable intangibles versus value left in goodwill? 5 seconds, answer out loud. Both come out of the same purchase price, but the earnings impact differs. Value allocated to finite-lived identifiable intangibles gets amortized over its useful life, a recurring non-cash expense that depresses GAAP net income and EPS for years after the deal, hurting accretion, years dilution. Value left in goodwill is not amortized, so it has no ongoing P&L drag. It only hits earnings if and when it's impaired, lumpy, unpredictable. So allocating more to goodwill versus amortizable intangibles flatters reported EPS. This is partly why acquirers emphasize cash EPS, adding back deal amortization, and why analysts scrutinize the PPA split. Neither affects EBITDA, since both amortization and impairment sit below EBITDA. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. Today's rep. Why do deals fall through? Walk through the main reasons. 5 seconds. Answer out loud. Price, bid-ask gap. Buyer and seller can't agree on value, often when rates or markets move during negotiation and one side anchors to a stale price. Financing falls apart. Debt markets tighten. A financing contingency is triggered, or the buyer's stock, in a stock deal, drops. Regulatory antitrust blocks or demands divestitures that break the economics. Diligence surprises. Accounting issues, litigation, customer concentration, or a material adverse change. Shareholder rejection. The target's board or investors or an activist push back, or a competing higher bidder emerges. Macro shock or loss of confidence that makes either side walk. Reps, Josh warranties or deal terms, impasse. Termination fees, indemnities. Many of these trace back to one root, a changed view of value or risk between signing intent and closing. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. This question ends Super Days. What are the two core levers of streaming revenue, and how do they interact? A service with 100 million subscribers at $10 monthly ARPU generates how much annual revenue? 5 seconds. Answer out loud. Streaming revenue is subscribers x ARPU. 100 million subs x $10 per month x 12 or $12 billion of annual revenue. The two levers pull against each other. Price increases lift ARPU, but push marginal subscribers to churn, while discounting and cheaper tiers grow subs at the cost of ARPU. Mature services shift emphasis from subscriber growth to ARPU. Price rises, ad tiers, paid sharing, once the addressable base is penetrated. When analyzing a streamer, always decompose reported revenue growth into the subcomponent and the ARPU component. The market rewards them differently because ARPU-led growth drops to margin faster. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps.